GST stands for Goods and Services Tax, which is a tax on the supply of goods and services in India. It is a single domestic indirect tax law for the entire country that has replaced many other indirect taxes such as VAT, CST, Central Excise Duty, Service Tax, etc. The Goods and Service Tax Act was passed in the Parliament on March 29, 2017 and came into effect on July 1. GST is a comprehensive, multi-stage, destination-based tax that is levied on every value addition along the supply chain of a product or service. Let us understand these terms in detail. Comprehensive. GST covers almost all types of goods and services, except a few items such as alcohol, petroleum products, electricity, etc., which are taxed separately by the central or state governments. Multi-stage. GST is levied at every stage of the production and distribution process, starting from the purchase of raw materials to the final sale to the consumer. For example, a manufacturer who makes biscuits pays GST on the inputs such as flour, sugar, etc., as well as on the output when he sells the biscuits to a wholesaler. The wholesaler pays GST on the purchase of biscuits from the manufacturer and also on the sale of biscuits to a retailer. The retailer pays GST on the purchase of biscuits from the wholesaler and also on the sale of biscuits to the end consumer. Value addition. GST is levied only on the value added at each stage of the supply chain. The value added is the difference between the selling price and the cost of inputs. For example, if a manufacturer buys raw materials for Rs. 100 and sells the finished product for Rs. 150, then he adds a value of Rs. He pays GST only on this value addition and not on the entire amount of Rs. Destination-based. GST is levied based on where the goods or services are consumed and not where they are produced. This means that the tax revenue goes to the state where the final consumer is located and not to the state where the producer or seller is located. For example, if goods are manufactured in Maharashtra and sold to a consumer in Karnataka, then GST will be collected by Karnataka and not by Maharashtra. GST has 4 tax rates: 5%, 12%, 18%, and 28%, depending on the type of goods or services. Some essential items such as food grains, milk, etc., are exempted from GST or taxed at 0 rate. Some luxury items such as cars, tobacco products, etc., are taxed at a higher rate and also attract an additional cess. GST has 3 components: Central GST, CGST, State GST, SGST, and Integrated GST, IGST. CGST and SGST are levied on intrastate transactions, i.e., when goods or services are sold within a state. IGST is levied on interstate transactions, i.e., when goods or services are sold across states. IGST is also levied on imports. The CGST and SGST rates are equal for each type of goods or services. For example, if a product is taxed at 18% GST, then it will have 9% CGST and 9% SGST. The IGST rate is equal to the sum of CGST and SGST rates. For example, if a product is taxed at 18% GST, then it will have 18% IGST. The CGST revenue goes to the central government, and the SGST revenue goes to the state government where the transaction takes place. The IGST revenue is shared between the central and state governments according to a formula. GST has simplified the tax system in India by eliminating multiple taxes, reducing tax evasion, increasing tax compliance, enhancing revenue collection, promoting ease of doing business, and creating a common national market. In this section, we will explain how some unscrupulous traders use fake invoices to cheat the nation of thousands of crores of rupees by claiming input tax credit without paying GST. Input tax credit, or ITC, is a facility that allows taxpayers to reduce their tax liability by the amount of tax they have already paid on their purchases. For example, if a trader buys goods worth 100 rupees and pays 18 rupees as GST, he can claim 18 rupees as ITC when he sells the goods and pays GST on his sales. This way, he he avoids paying tax twice on the same goods and only pays tax on the value added by him. However, some fraudsters exploit this facility by creating fake invoices without any actual supply of goods or services. They use these fake invoices to claim ITC and reduce their tax liability, or even get refunds from the government. For example, suppose a fraudster A issues a fake invoice of 100 rupees to another fraudster B without supplying any goods or services. B pays 18 rupees as GST to A and claims 18 rupees as ITC when he sells the goods or services to a genuine buyer C. A does not deposit the 18 rupees collected from B to the government, and instead keeps it for himself. Thus, A and B together cheat the government of 18 rupees by using a fake invoice. This fraud can be repeated multiple times by creating a chain of fake companies and issuing fake invoices among them. For example, A can issue a fake invoice to B can issue a fake invoice to C can issue a fake invoice to D, and so on. Each of them can claim ITC on the basis of these fake invoices and reduce their tax liability or get refunds from the government. The government loses revenue every time a fake invoice is issued and ITC is claimed. According to a report by Hindustan Times, the GST authorities have arrested 215 people, including CEOs, chartered accountants, and company secretaries, for fraudulently misappropriating input tax credit by using purchase invoices issued by fake companies. The total amount involved in these cases is estimated to be around 30,000 rupees crore. The government has taken several measures to curb this menace of fake invoices and GST fraud. It has introduced an e-invoicing system that generates unique invoice reference numbers for every invoice issued by registered taxpayers. It has also launched an offense database module that flags the GSTIN of entities that have been charged with fraud and alerts the authorities for further investigation. It has also issued circulars and guidelines to clarify the applicability of demand and penalty provisions on transactions involving fake invoices. Fake invoices are not only a threat to the revenue of the government, but also to the economy and society at large. They distort the market competition and create an unfair advantage for dishonest traders over honest ones. They also undermine the trust and confidence of the public in the GST system and its benefits. Therefore, it is important for all stakeholders, including taxpayers, consumers, authorities, and media, to join hands and fight against this menace and protect the nation's interest.